It's a mixed bag on the local front today with the JSE upbeat and including the rand slightly weaker. The JSE All Share index closing in the green on Monday, mainly supported by heavyweights Naspers and Prosus, including the resources-linked sectors. Now, global investors embraced encouraging developments in China's economy, particularly in consumer and producer prices, while eagerly anticipating the upcoming release of the US CPI data on Wednesday. Let's talk now to Benguela Global Fund Managers. Senior Portfolio Manager there is Grant Nader, as opposed to Carl Gevers. Grant, good to have you. Thank you very much for your time. Let's kick off the conversation with your quick overview of how local trade is faring this morning.
Yes, following on from a positive day yesterday, which was nice to see, we marginally up this morning. It is a little bit of a mixed bag. We see the telcos and the healthcare space doing nicely to open, and on the laggard side we have the food producers sort of maybe digesting some of the moves that I've seen recently. But I think it's early in the day. There's a slightly cautious tone. Volume is quiet. I think we're waiting some of the big numbers out this week. As you mentioned, the inflation data is going to be a big driver of what comes next. So cautious but positive start, and we'll take it at this stage.
Yeah, let's talk about oil. Brent crude futures held above $90 a barrel in early trade. What's driving moves there?
So that's a continuation of this theme we've seen for a while now. You know, the voluntary extension of the oil cuts, production cuts from Russia and the Saudis have really put an underpin in the oil supply, shortened the supply of oil. And then you couple that with the strategic petroleum reserve in the US, which is now at multi-decade lows. So their hand is being held behind their back there. They can't release much stock into the market to offset the supply cuts. And the two combined, plus you're finding that there's stronger underlying growth coming out of countries like the US. So demand is holding up better than many had expected. Supply is being squeezed, and so this is keeping oil at or near these yearly, or the highs of the year so far. It is a bit of a concern. We've got two big reports coming out at the end of this week, the monthly from OPEC and the US Energy Agency, so we'll watch for signs there as to what they expect to do going forward.
Let's talk company news. Transaction Capital publishing a trading statement and a pre-close operational update. This is in respect of the year, which ended on the 30th of September 2023. How did they perform?
So I think a couple of things stood out there. The number one is the CEO resigning, leaving at the end of December. I think it's probably not that much of a surprise given the journey that this stock has taken over the past while and some of the fallout that there's been around SA Taxi. And then looking deeper into the sort of update, there are understandably going through quite a significant restructuring around the SA Taxi business, trying to sell down excess inventory, trying to improve costs, improve credit, improve collections. But a lot of this comes at a significant cost. They need to repair the balance sheet. So all of the associated costs, the restructuring, etc., is going to heavily impact earnings for this year. And then if we look at the rest of the business, the We Buy Cars, they're still coming off a very high COVID base, post-COVID base, I should say. They expect earnings to be down over 20% year on year. And then the rest of the business, Nutton and Gomo, they're doing okay. They're still growing, but they're growing at a slower pace. So all in all, it's a tough spot for SA Taxi at this moment. They've got a lot of work to do to rebuild investor confidence. And I think there's still quite a bit of water to flow under the bridge on this one.
Let's conclude the conversation with Libstar's interim results for the 6 months ending the 30th of June 2023. Their results are out as well. How are they faring?
I would have to say this was a rather disappointing update. Revenue grew 4%, but ultimately converted into a loss of 44% on a headline earning basis. Really, we saw margins being squeezed tremendously. You know, the company did say they're coming under a lot of input cost pressure. That's hurting them. Volumes are down 7%, so they managed to grow revenue, but at the cost of a lot of loss in volume and market share, I would imagine. They're not able to, the typical thing around load shedding, that's one of the constraints. Input costs is a constraint. Rising interest rates have hurt their margin as well because they do hold a reasonable amount of debt. So they are catching pain on every side, and it's evident, as you would expect from many companies in this tough environment. They're now looking at, they're doing a portfolio overview, looking to streamline, rationalize the portfolio, and try and cut costs where they can and optimize for volume. These businesses thrive on volume, they thrive on production, and really this one really is struggling, and probably more so than the other food producers that we've seen report so far. So it is a bit of a concern, and I hope they can get on top of it.
Grant Nader, let me thank you very much for that markets update. He is a senior portfolio manager at Benguela Global Fund Managers. All right.